Avoid letting greed ruin you. With $37 billion, Warren Buffett invested $488 million in PetroChina in 2003. It didn't seem like a sensible investment at the time. But a couple of years later, oil prices surged and China's economy showed no signs of slowing down. And with a succession of positive basic earning reports, PetroChina's shares jumped to $1 trillion valuation. Buffett might have profited $13 billion from this acquisition, but he only made $3.5 billion after selling all of his shares when the company was valued at over $300 billion. Avoid being very avaricious, because reading might cause you to lose far more money than you could possibly gain. Although he had the option of waiting longer, how could he possibly predict when it would crush? Currently, PetroChina is valued at almost $100 billion. Diversification is a waste of time. What proportion of equities should you typically own? How do you feel? While some claim that your portfolio has to be sufficiently diversified with 10 to 30, experts recommend 20 to 30. But here's the catch. Imagine if you're looking at a fantastic business with outstanding goods, solid financials, and top-notch management and leadership. If you had the chance to invest in this company, why would you choose to do so in any other? Diversification is therefore not a particularly effective technique. Yet, you could object that there aren't many businesses like that, and you'd be right. For this reason, you should only invest in a select few outstanding businesses. How many stocks ought you to own? Then, analyze its financial statements after reading them. It goes without saying that you shouldn't put all of your eggs in one basket, but you should diversify your portfolio by investing in a growing number of businesses. There are several excellent businesses on the market that have been continually successful, including Coca-Cola, Apple, and Hathaway. They are such outstanding businesses that they will undoubtedly weather any storm and keep expanding. Since the last recession, the stock price of each of these companies has increased by at least a factor of 2. Dividends are important because stock price is what most people consider when trying to profit from the stock market. Simple buy cheap and sell high is an excellent trading technique, but stocks offer stake in the firm, which means that every time it generates money, it must send you your share of that money, which is known as dividend. A stock by itself isn't really all that beneficial, but if the stock price is increasing over time, you will undoubtedly become richer. Nevertheless, until you sell that same asset for a higher price, you can only actualize your wealth on paper. It's similar to buying a piece of property and then holding onto it till its market worth rises, rather than renting it out to make money every month and then using that profit to possibly buy more property, or using these profits to buy even more stocks and become richer. Passive income is excellent, but occasionally it's better if the business doesn't pay dividends, particularly if it's just getting started or if it has the ability to reinvest its profits to expand much more quickly. The stock market isn't your only choice, though the stock market, real estate, or government bonds are the first things that come to mind when you hear the phrase investing. Even while they are all excellent financial instruments, they might not always be the best option for you. Keep in mind that investing comes in a variety of forms. The business you've been considering for a while might occasionally be the ideal investment for you personally, or perhaps if you love graphic design and have lots of free time after work, investing in a Photoshop course could provide considerably higher returns than putting that money in the stock market. A self-help book or a financial book may have a much greater long-term impact on your life than any other sort of investment. Investment doesn't necessarily have to lead to instant materialistic rewards. The key is to think creatively. The chance can be right in front of you. Patience is the key. After several months of saving, you have finally earned enough to invest. Nevertheless, you won't always find fantastic deals in the market. When an opportunity arises, you must act quickly to seize it. Yet, there are frequently traps that will only steal your money. Do your research, read one more article, and only invest if you feel sure enough. That also holds true for selling. If the market is down, don't be a fool and panic and sell all of your stocks right once. Maybe it will just be temporary and the stock price will rebound. Learn to be patient instead of being ruled by your emotions. The first thing that springs to mind when you think of the stock market is this convoluted environment in which no one seems to really comprehend what is happening. And every time things seem to be going our way, a financial catastrophe strikes. But one man seems to have a special insight into investing unlike everyone else. He consistently made profitable investments throughout his life, earning him the reputation as the best investor ever. He was so talented that at the young age of 16, he had already earned $53,000. How Warren Buffett makes investments. This is the method he uses to choose a stock, step by step. He doesn't invest at random. In fact, if you look at every company in which he has ever invested, you'll see that they are all connected. They behave extremely similarly and share many of the same characteristics and ideals. Let's find out why he favors one stock over the other and chooses this business above all of his other possibilities. Warren Buffett is a long-term investor. He is not concerned with the performance of the company today, tomorrow, or even in a year. What the company will look like in 10 or 15 years is his main focus. But if a company is really complex, it is quite difficult to anticipate this. So it basically looks for businesses that are straightforward and clear. These are the clients, these are the products, and this is why they are going to buy it. Its business concept is so straightforward that even a young child could comprehend it. You don't need to be a genius to understand it. That's what Buffett likes, since it makes it easier to forecast if a company's product will still be relevant in 10 years. The simpler the business plan is. The second characteristic is if the customer will repurchase the goods and why. And this is quite significant because your market is constrained if you have the kind of product that sells only once before the customer no longer needs it. A fantastic product is one that your customers will continue to purchase every day, every week, or even every year. For instance, if you sold bread, you would anticipate that the exact same products will continue to be available tomorrow, next week, and 10 years from now. It may be offered in a different format or manner. Its quality may be enhanced, and it may be presented in a better box, but it is still the same item that customers would continue to purchase. And that's why, despite the fact that the iPhone is not a need like a bread, people continue to purchase it every September, making it one of the greatest goods in history. In actuality, that is what has caused the subscription business model to become so popular, where companies would charge you a little price each month, like Netflix does, or every year, as Amazon Prime does, since that is a more sustainable business model. The brand is the third element. Consumers tend to patronize businesses with whom they identify or feel a sense of familiarity. Whose shoes would you purchase? The first pair is from an unknown company, while the second pair is a classic pair of Nikes. Even if they were more expensive, you probably wouldn't buy them because you had never heard of the name. Conversely, you can immediately recognize Nike because it is a well-known company, and they are known for producing high-quality footwear. Perhaps you're already sporting a pair of Nike shoes. What would you pick? And that's why Buffett considers how strong a brand name is before investing his billions in a firm. He is aware of how much of an impact it will have on the consumer's choice. In fact, if a company has a strong enough brand, customers will buy practically anything it sells. One of the biggest investors in Coca-Cola is Warren Buffett. Since he first began investing in Coca-Cola in 1988, his investments had increased more than 16 times. Coca-Cola is one of the few businesses that possesses every quality Buffett considers before making an investment. First of all, anyone could comprehend their business plan because it is so straightforward. Do they sell anything? Who are their prospective customers for a drink? Is it a one-time product, or do their customers frequently return for it? Pretty much everyone in the world is thirsty. It makes sense that they would keep returning since some folks consume 4 or 5 cans every day. One of our most fundamental requirements is met by this product, which is also addictive once you became used to it. Even if it's unhealthy, quitting is difficult. Yet, it faces numerous rivals, and because there are so many soft drinks available, it sometimes seems as though a new soft drink firm is launching every day. But the Coca-Cola brand is so well known that you can readily choose it out of 20 or 30 alternatives. Coca-Cola is likely to be chosen by the majority of people automatically. And if it is out of stock, you are likely to visit another store rather than selecting one of the other 30 possibilities. Every day, 1.8 billion cans are sold. If the corporation were to make just 1 penny from each can, it would amount to $18 million per day, or $6.5 billion annually. Nonetheless, they are able to charge more than a penny for each can because to their strong brand. For this reason, in 1988, Buffett invested $1 billion in Coca-Cola stock, his largest investment. He was convinced that the company would continue to thrive whether the economy crashed or another financial crisis was imminent in 10, 20, or even 30 years. Another illustration is Warren's investment of $600 million in Gillette in 1989. If you look closely, the manufacturer of razors, Gillette, has the same position in its sector as Coca-Cola does in the beverage industry. Regardless of what happens, people will continue to shave. Gillette isn't the only company in its market. There are a lot of rivals. Yet, their products simply satisfy a basic human need. You don't need an IQ of 150 to comprehend why people buy razors or why they would continue to use that product even in 10 years. If you ask people to identify a razor brand other than Gillette, they might respond. You can see how it precisely satisfies all of Buffett's criteria. It is a straightforward product that customers would continue purchasing, and it has a well-known brand. 90% of individuals won't be able to achieve that. The same thing happened with See's Candy. In fact, despite the fact that the company wasn't as profitable as Buffett desired, it had a very powerful brand that made all the difference. It was one of his best investments ever. Buffett understood that most candy purchases are made as gifts for other people, which encouraged repeat business for special occasions like Valentine's Day, Christmas, and birthdays. The business was turning a profit of about $4 million when he bought it in 1972 for $25 million. For the subsequent 35 years, company profits climbed 20 times. Their revenue in 2007 was more than $82 million. Buffett has never been involved in the technology industry, but recently he made a significant investment in Apple. We live in a time when technology is more of a necessity than a want, and Apple keeps producing the kinds of technology that keep customers coming back. Many of Apple's ardent supporters update their iPhones annually. Apple is not the only tech corporation, but it undoubtedly has the most well-known brand. Even after taking into account all the other elements that will affect the company's future, you still need to look at its financial accounts because every business is different and faces different challenges. But generally speaking, these are the three most crucial aspects to take into action when deciding where to invest your money. 7 financial realities that we wish we had known earlier. Good deals become excellent deals thanks to leverage. It's such a bad perception of debt, even without considering the interest that is added on top of it. It turns out, though, that it's not as horrible as we thought. In some circumstances, like this one, it's beneficial. Consider the scenario where we have $1 million in cash and wish to buy a property. If your credit is extremely good, you may be able to acquire a mortgage at a rate of 3, and you could use that $1 million to buy a house, or you could get a mortgage and invest it somewhere else, like the stock market, where you could earn 7% annually. In the second case, By using it, you not only buy the house but also allow the money to increase by an additional 4%. Because we didn't account for down payments or market swings, this is a basic illustration, but the general premise is the same. Every great real estate investor has utilized this in some capacity in order to get where they are today. Frequently, they use their initial mortgage as collateral in order to obtain subsequent mortgages, which they then rent out. You can use that to save yourself decades worth of time rather than having to save enough to buy each property. Nobody enjoys paying taxes, but the tax code isn't always clear-cut. With the exception of the income tax, which increases with income up to a maximum of 37%. But there are several loopholes that allow you to earn millions of dollars and pay no taxes at all, because you could appear to be losing money on paper. For instance, let's say your mortgage is for $300,000 and the interest rate is 3%. You can deduct your mortgage interest from your rental income. So if you earn $30,000 from that home, you could also be deducting $9,000 from it. You suddenly only have to pay taxes on $21,000 instead of the original $30,000 amount. Hence, even if you have the means to purchase the property, it is still preferable to obtain a mortgage. Depreciation is another factor. Almost everything we purchase depreciates over time, and tax regulations typically permit you to deduct depreciation as an expense even though you gained nothing. This will further reduce your income on paper and cut your taxes. Businesses frequently employ this method. If you simply choose any company's financial accounts, you will notice that depreciation is always present in the income statements. If you acquire another home in exchange, you may even be able to avoid paying taxes when you sell the first one. It becomes simpler the more money you earn. It's challenging to envision earning millions or even hundreds of thousands of dollars when you're struggling to make ends meet. Working more hours can allow you to quadruple your income. But in reality, money doesn't truly operate that way. Getting your first $100,000 is considerably more difficult than earning your first $1 million, because as you make more money, more chances will present themselves to you. It could take you several years to save enough savings to qualify your first mortgage, but the second one is much simpler. Don't give up if you can't imagine earning more. Instead, concentrate on saving your first $20,000, $50,000, or $100,000, or on purchasing your first house.